My next guest is also concerned about the U.S. government's ability to put politics aside and do what is best for this nation's economy. Well, Marshall Sonenshine is chairman of Sonenshine Partners. He has advised on billions of dollars of M&A deals. Welcome, Martin. Good to see you. Marshall, excuse me. It's been a confusing day. Thanks for joining us here on Fast Forward. Now, a lot of deals have been put on hold, and I don't mean in the M&A sector necessarily, but I've seen a lot of corporate issuance has fallen quite dramatically, and we've seen this with muni deals. What's happening in the M&A sector? Is it having the same impact?
Well, M&A is the ultimate statement of conviction about buying a whole company as opposed to buying shares in a company on a stock exchange or financing a company as part of its ongoing operations. When you buy out a company, you're making a very powerful statement about your belief in that business, and you're financing the entire cost, presumably, of that company. So inevitably, when you have this level of uncertainty or volatility in the market, you'll see some slowdown. But I do think one has to put that in the context of an M&A market that in the first half of this year has been rather robust, actually remarkably so in the context of a post-financial crisis period in which M&A really did dry up considerably more at the beginning of the crisis years, and then really came back with some conviction in the first half of this year. So we have to see how this plays out. But sure, there will be some dislocation and a bit of slowing down.
Are there deals that you think won't end up getting done this year because of what is happening? Maybe not as it relates specifically to just the downgrade, but because of everything happening in D.C.
Sure. M&A is fragile. Lots of things cause a deal to happen or not happen. Uncertainty will slow things down. Buyers and sellers have to agree on price. Buyers have to find financing that they can tolerate. Ironically, in the face of this debt downgrade, we've actually seen a reduction in U.S. bond rates. Maybe it's not so ironic, but it's a statement that in the end, when you have this level of uncertainty, it's still the good old U.S. paper that people flock to in a flight to quality environment, and interest rates are very low. But sure, there'll be some uncertainty, and some deals will get kicked over from this year to next year, or will slow down or get derailed, and the company will go in some other direction.
Hey, Marshall, Adam on the floor of the New York Stock Exchange.
Adam, how are you?
Hey, very well, thanks. Shed for us a little light, if you can, on the financing process of these deals. How many deals, or what percentage of the deals, actually require bank financing as opposed to private financing from the investors themselves?
Well, you're asking a very broad question, Adam. Of course, M&A comes in all shapes and sizes and flavors. If you're talking about financially driven M&A, private equity and the like, a typical capital structure today might be 60% debt, 40% equity, and of the 60% that's debt, it might be half to two-thirds or more that is bank financing. So bank financing is awfully important. On the corporate M&A side, which I continue to think is the more important sector, even with a rising and renascent private equity buyout industry, it is corporate buyouts that are really driving the first half of this market. It's all about credit. So if you're a good credit company and you have the ability to finance yourself, then you have the ability to make acquisitions. And if you don't, you're not making acquisitions right now. And that's probably where you've seen the greatest drying up of the M&A market is lesser credit acquirers having a pretty tough time right now.
And given that the U.S. corporations have, in theory, $1.6 trillion of cash on the balance sheets, which is as high as it's ever been, could you make the argument that U.S. corporations don't actually need the banks, that they're in a position to spend their cash, or are they still conserving it?
Well, there's need and there's want in this life. Look, private equity firms also in aggregate have some $500 billion of capital that is dry powder that they have not used in the course of these last couple of years since the financial crisis. And it isn't because they're raising a lot of new money. They've had it for some time. There is a certain cautiousness. You have to have conviction to use your capital. And you don't see private equity firms doing all equity deals when they couldn't get bank financing. And I don't think that corporations are going to say, if we don't have financing, we're still going to use all of our cash on an acquisition. They could, in theory. They tend not to in practice, or even if they use all their cash, they're intending to do some refinancing. On the other side, M&A is often a floor on markets. And when you get to this level of uncertainty, when it starts to plateau out again, and let's say the market plateaued at 11,000 or 11,000 and change instead of 12,000 and change, you are going to see folks come back into the market. Just last week, in the middle of this debt crisis, Blackstone bought a company, Endemol, for $3 billion. Li Ka-shing, also essentially a financial buyer, bought a British utility water business for $4 billion. I mean, that was last week. This is not removed from the current environment. So people will use cash when they know they can do financing. Rates are low. There's still some activity.
All right, Marshall. Sounds like once we stabilize, when that happens, and if it happens in the near term, all the stars are sort of aligned for a very active deal calendar. All right. Thanks so much, Marshall. We got to leave it there.